The 2008 global recession was a severe financial crisis that began in the United States and quickly spread around the world. It was triggered by the collapse of the US housing market, which was fueled by risky lending practices and a surge in subprime mortgages. As housing prices fell and borrowers defaulted on their loans, many financial institutions faced significant losses and were forced to write down the value of their assets. The crisis quickly spread to the broader financial system, as banks and other financial institutions struggled to secure funding and faced a liquidity crunch. The crisis reached its peak in September 2008, when Lehman Brothers, a large investment bank, filed for bankruptcy. This event sent shockwaves through the global financial system and led to a widespread loss of confidence in the financial markets. The crisis had a severe impact on the global economy, as GDP and employment rates fell, stock markets crashed, and housing markets collapsed. Many countries implemented stimulus packages and other measures to stabilize the economy, and central banks lowered interest rates to boost lending and encourage economic growth. The 2008 global recession was one of the most severe financial crises in modern history, and it had a significant impact on people's lives, businesses, and economies all over the world. Causes of the recession. Subprime mortgage crisis. The subprime mortgage crisis was a major contributor to the 2008 global recession. Subprime mortgages are home loans made to borrowers with poor credit who are considered a higher risk of defaulting on their loans. During the housing boom of the early 2000s, many banks and other financial institutions began to relax their lending standards and make more subprime loans. As housing prices rose, many borrowers took on more debt than they could afford, and when housing prices began to fall, many borrowers defaulted on their loans. This led to significant losses for the banks and other financial institutions that held these mortgages, and many of them were forced to write down the value of their assets. Credit crunch. The subprime mortgage crisis led to a credit crunch, which is a shortage of funds available for borrowing. As the value of the subprime mortgages held by banks and other financial institutions fell, they faced significant losses and struggled to secure funding. This led to a lack of liquidity in the financial system, and many banks and other financial institutions were forced to close or merge with other companies. Banking and financial institution failures. As a result of the subprime mortgage crisis and credit crunch, many banks and other financial institutions failed. Lehman Brothers, a large investment bank, filed for bankruptcy in September 2008, which sent shockwaves through the global financial system and led to a widespread loss of confidence in the financial markets. Role of deregulation and lax lending standards. Deregulation and lax lending standards played a significant role in the 2008 global recession. Deregulation, which is the removal or reduction of government regulations, allowed banks and other financial institutions to engage in risky lending practices and make more subprime loans. Lax lending standards, which is the loosening of the criteria that banks use to determine whether a borrower can qualify for a loan, led to more risky lending and a surge in subprime mortgages. Economic impact. GDP and unemployment rate. The 2008 global recession had a significant impact on the global economy. GDP, or gross domestic product, which is a measure of the total value of goods and services produced in a country, fell in many countries as a result of the recession. Similarly, unemployment rate, which is the percentage of the total labor force that is unemployed but actively seeking employment, rose in many countries as businesses cut jobs and closed down. Stock market crash. The 2008 global recession also led to a stock market crash, which is a significant decline in the value of stocks. As the crisis spread and investors lost confidence in the financial markets, stock prices fell sharply. Many investors lost a significant portion of their savings as a result of the stock market crash. Housing market crash. The 2008 global recession also led to a housing market crash, which is a significant decline in the value of housing. As housing prices fell and borrowers defaulted on their loans, many homeowners found themselves underwater on their mortgages, owing more on their homes than they were worth. This led to a decline in housing construction and a fall in demand for housing-related goods and services. Effects on global trade and investment. The 2008 global recession also had a significant impact on global trade and investment. As businesses and consumers cut back on spending, demand for goods and services fell, leading to a decline in exports and a fall in imports. The crisis also led to a fall in investment as businesses and investors pulled back from the markets. Trade and investment are the backbone of any economy, as they connect countries and businesses, and the fall in them led to huge losses and slowdown in the economy. Government response. Bailouts and stimulus packages. The government response to the 2008 global recession included a number of bailouts and stimulus packages designed to stabilize the financial system and jumpstart the economy. These bailouts and stimulus packages took various forms, such as infusing capital into struggling banks, providing loan guarantees to businesses and individuals, and increasing government spending on infrastructure and other projects. The goal of these measures was to stabilize the financial system and to boost economic growth. Role of central banks. Central banks also played a major role in the government response to the 2008 global recession. Central banks, such as the Federal Reserve in the United States and the European Central Bank in Europe, used a variety of tools to stabilize the financial system and to boost economic growth. These tools included lowering interest rates, providing liquidity to banks, and buying assets such as government bonds and mortgage-backed securities. Impact of monetary and fiscal policy. The government response to the 2008 global recession also involved the use of monetary and fiscal policy to stabilize the economy. Monetary policy is the use of interest rates and other tools to control the supply of money and credit. Fiscal policy is the use of government spending and taxation to influence the economy. Both monetary and fiscal policy were used to stabilize the economy during the 2008 global recession, with a focus on increasing government spending and lowering interest rates to boost economic growth. Conclusion. Summary of key points covered in the video. The conclusion of the video would summarize the key points covered in the video, such as the causes of the 2008 global recession, the economic impact of the recession, and the government response to the recession. It would be a summary of all the major points discussed in the video so far, and it will provide the audience with a clear understanding of the 2008 global recession. Conclusion. Discussion of the lessons learned and ways to prevent future recessions. The conclusion of the video would also discuss the lessons learned from the 2008 global recession and ways to prevent future recessions. This would include a discussion of the various factors that contributed to the 2008 global recession and how to address these issues to prevent similar crises in the future.